Hello, everyone, and welcome to another WiZDOM update. Look, I do need to apologize. It's been a little bit of time since I've been able to bring you an update. I've been really crazy busy bouncing around the country, seeing a lot of you in person at the various events that I've been to. And also, I'm working on a really secret project that I can't tell you about, but we've got a whole new program that's coming out soon. And I'm really excited to bring that to you in the near future. So, what's going in the economy? What do we need to talk about? What am I anticipating we're going to see in the near future? Let's get right into it. Okay, so where we're going to start is we're going to talk about inflation. And look, the great news here on inflation is that we have absolutely seen inflation come back to within the target band for the Reserve Bank of Australia. So, just in case you don't know, the target band is always 2 to 3%. That's where Reserve Bank wants to see inflation. That's considered to be good and stable for the economy long term. And we've now seen essentially both measures come back within that band. So the main inflation data, that's actually sitting at 2.4 as at March 2025. And even the trimmed mean, which is essentially the ones where they adjust the inflation data for all of the various things that are going on, like, for argument's sake, the government providing support around power bills. That all goes into the trimmed mean, and we've actually seen the trimmed mean come in at 2.9 as well. So both of those main sources of data, they absolutely are falling within that band. So what does that do? Well, the reality is that starts to pave even better way forward with regard to the Reserve Bank on reduction of interest rates. So let's talk about where they're at. So this is essentially the latest predictions from the four banks around what they're anticipating with regard to interest rates. So you can see there that over the course of 2025, we've got ANZ expecting that the main interest rate coming down to, there's a Reserve Bank cash rate coming down to 3.6. We've got NAB and Westpac there predicting by the end of 2025 that we'll see that at 3.1, and CBA is the most aggressive with reductions coming in at 2.85. But what does that actually mean from where we're sitting right now? Well, look, there is a bit of a mixed bag, and I know that there's a lot of talk out there about with Trump tariffs and all the crazy stuff that's going on in the world that we might see a reduction as much as 0.5% at the May meeting. Look, I'm not there. So right now, we haven't really got enough data, and that data is significant enough, I think, at this point in time for a relatively conservative Reserve Bank to be going out there with a full half an interest rate cut. So I'm anticipating at this point that we will only see a reduction of 0.25% at the next meeting in May, which is only in a week and a bit's time. So the announcement will be made on May the 20th, which is a Tuesday, and I'm anticipating that we will see a 0.25 reduction. Then, of course, we're likely to see quite a few more reductions after that. I'm anticipating we will see at least another 2 cuts of 25 points each across the remainder of 2025. And so that would sort of complete that full 1% that I was expecting that we would see in 2025. And look, I would anticipate that we'll see that somewhere around, that November, probably an August cut, and then maybe again in November. Now, that's barring, the world events that have been happening around the Trump tariffs and all of the crazy stuff. That's barring that all of that sort of calms down a little bit and we just see, I guess, a normal trajectory in world economic growth or expectation of world economic growth, and as a result of that, Australian growth as well. If we see big, substantial changes there, or if Trump, does actually deliver on these substantially high tariffs that he's obviously been talking about, well, then it is possible that we do see further reductions. Probably only another 0.25 on top of that at this point in time. We can't shy away from the fact that the Reserve Bank is absolutely conservative and they tend to only make decisions off the back of actual data that's been delivered rather than speculative data moving forward. And so as a result of that, I think delay in data and other things about any of those events will, at this point in time, I expect that we would only see an absolute maximum of 1.25% across 2025. It's probably more likely that we'll still just see that 1% that I've been expecting the whole way through. Now, what does that mean for everybody? Well, it means quite a substantial amount, in fact. Each 1% decrease of interest rate roughly equates to $75,000 in extra borrowing for a $100,000 income. So, as I've been saying for a long time now, these interest rate reductions are absolutely going to put more money in people's pockets. They're going to be able to borrow more money. And as a result of that, I absolutely expect that we will see that extra money flow through into the property market in the form of growth. We'll talk more about the property market in a sec. But historically, wherever we've seen a full 1% of interest rate cuts in the economy, it roughly equates to an 8 to 10% growth in the property market overall. So again, this is going to really play out in the property market, and I do expect that it's going to be very supportive around further growth. Now, I haven't got a slide on this as well, but it's probably worth very quickly talking to what we've had happen recently with regard to the federal election. Of course, Labor has been put into power again. Nothing wrong with that. What does that mean for property? Again, not a lot. Like, I know that a lot of promises were made from Labor, and they are throwing a huge amount of money at trying to improve the supply side of property and bring, more affordable property into the market for first home buyers and others. But the reality is, for me, is that there's big time periods that have to play out there. Like, you can make the decision today that you're going to throw lots of money at producing new property, but there is absolutely a huge lead time with regard to that. If it's infrastructure, that takes a long time to build. Even if you're releasing, and rezoning and doing other things around land, that still takes a long time to develop that land and actually create blocks that people can build on. And of course, then they actually need to build a home before they can reside in it. And so, whilst that supply side might play out, my expectation is that any improvement there is going to take a number of years. And as a result of that, because we're such a shortage with property in general in Australia, it's really not going to change or substantially change the amount of demand that is out there. And the supply just won't keep up with that. It will take time to deliver. And as a result of that, we're still going to see large shortages in property, certainly in the near term. The other thing is that, again, both sides of government before the election and now Labor, they did still do a lot with regard to the demand side of property. In other words, they've increased a lot more with regard to income and property value limits with regard to the support that they're doing. They're going to expand the shared equity scheme that Labor is really supportive of. So all of that in the short term is actually going to increase demand from a property perspective. Again, it's going to put more money in first home buyer and other people's pockets to be able to spend on property, which again, I think is going to play out in, increased prices right across the property market over the shorter term. So as a result of that, really, from an election perspective, I'm not anticipating that we're going to see, any reduction in the property market. In actual fact, it's probably going to increase the property market overall because all of their other measures are going to take so much time to deliver. So let's talk about the property market. What am I seeing? What am I expecting? And look, I know I have showed you all this before. It's one of the things that I quite like. This is the Heron Todd White Property Report, the month in review, they call it. It's just on the website. You can go there, download a copy of this every time. And this is the property clock that they put out every month. Now, specifically, we'll have a look at the houses and as well the units. Now, what we're looking for with regard to the property clock is any of the places, any of the locations that are shown up in colour means that they've moved from the previous month. And so this month, we've only seen Darwin move, but it is quite interesting that Darwin has moved from their perspective or their review of Darwin from the start of recovery where it was in previous months, and it's now moved into a rising market. So we're seeing growth in Darwin. And as a result of that, the expectation certainly in the short to medium term is that Darwin is going to continue to grow from Heron Todd White's perspective. Now, again, we haven't seen any other movement at this point in time. I can tell you the ones I'm watching really, really closely are the Victorian ones. And I will get to a different graph in a minute as to why I'm so interested in that. But as I've been saying for a long time, I absolutely expect that Melbourne particularly, and then Victoria by virtue of that, will be growing fast. And my expectation will be, it will be the best performing property market in Australia very, very quickly, and will continue to grow for a period of time. And so I'm watching that very, very closely, that data, because I'm absolutely anticipating that is going to swing around the bottom of this clock, into a rising market very, very quickly. In fact, it won't surprise me if it actually jumps a bunch of spots and gets over into that start of recovery and rising market really quickly. Now, if we look at units, again, just the same property clock. The only movement that we've seen here this month is Shepparton. So again, it's gone from from peak of market to starting to decline. That doesn't surprise me. The regional locations have a tendency to follow the capital cities when it comes to states. As a result of that, we're seeing the regional locations in Victoria follow Melbourne. And again, I think they will continue to follow that around the rest of the clock as Melbourne continues to move. On the other side, we've seen Canberra come across into start of recovery in units as well. So again, this is openly available to you guys. It's all on Heron Todd White website. You can go there, download. They have, there's a huge detail. It's a massive, massive report, and they go into all of these markets quite closely, and in detail. And you can read, I guess, a bit about more where you're looking to invest or potentially where you're looking to buy property. And there's great data there available, and a lot of information for you. So if we look at, I guess, what's happening in the price space, well, this is really interesting as well. So effectively, this is at the 30th of April. This comes from CoreLogic. And again, they're one of the biggest providers of data when it comes to property in Australia. And really, really interesting. So we can see, all Sydney, Melbourne and Brisbane are the top performing markets in Australia right now. Sydney, we've got monthly growth of, and Melbourne, we've got monthly growth of 0.2% for a quarterly percentage growth of 1%. And then, of course, that extrapolates out. They show the annual data there as well. Now, what's really interesting for me in this, of course, is Melbourne, right? So whilst it's still technically running on an annual, which is negative of minus 2.2% in the market overall as an annual return, very interesting that its course have now switched to positive. It's grown by another 0.2% in the month of April. And that quarter is, it's an equal best performing with Sydney and Brisbane if you look at that quarter data as well. Now, my expectation is we will see the monthly data continue to improve, and of course, then that flows out in the quarter and the annual overall. But very interesting that it's gone from, one of the worst performing markets in Australia now to one of the better performing markets in a very short space of time. So overall, though, pretty much right across Australia, a good story is being told. Now, it is important to understand that we did see our first rate reduction in March, and I think some of that would be playing out here, but it's really early for rate reductions to be playing out in the market as well. Like we would expect to see some lag between, the interest rate changing and then people reacting to that, and obviously, going and buying property and physically impacting all of this data. Expected as we continue to see rate reductions, of course, that's going to continue to play out in the property market as well. But it's all good news for Australia. As I've spoken a lot, in the last couple of years, and I will continue to say this for the next couple of years, the Australian property market is going to perform really well across 2025 and 2026. Now, of course, that doesn't mean you should be buying any property anywhere. It always comes down to, understanding that local information, educating yourself around where you're buying, because at the end of the day, we always buy a house in a street. And so as a result of that, we need to not look at this mass national data or even state-based data. We need to be thinking about those local economic factors and be buying in the right spots to maximize our overall outcome. However, it's good to know that the entire market is growing, which puts us in a great place for specific areas to do really, really well. How long is all of this going to last? Now, I'm sure that some of you have potentially seen this before, but there is a guy called Phil Anderson who wrote a book back in 2008, which is called The Secret Life of Real Estate and Banking. And what that talks about is effectively, on average, how property, particularly in the US, operates on an 18 year and 6 month cycle. And I guess what's interesting about this, or I guess why I'm starting to think about this, is that according to his predictions, we are towards the end of an 18 year cycle, and we need to start thinking about that downturn that may be coming at some point in the future. Now, I understand this is completely contradictory to what I just said about Australia's going to grow really well across 2025 and 2026. I absolutely expect that it is. In fact, I expect with the interest rate reduction and everything else, we're going to get very good growth, or continue to get very good growth right across the market. However, we all know that cycle, that growth cycle will eventually end. And I guess it's important to understand, if we can start thinking about that, what that looks like. At least his predictions, which effectively go all the way back into the 1800s, and it shows various points in time as to how that played out and what that looked like. The current cycle is expected to end about sort of 2027. Now, what does that mean? Well, the reality for us means that we need to be potentially thinking about shorter term deals rather than longer term deals if there's going to be some kind of global correction or global recession that may occur towards that period of time. Really the safe bet here is doing good manufactured growth strategies, but preferably ones where you're going to be out before the end of next year. So that means, an 18-month period of time or thereabouts. Now, with big townhouse transactions probably taking a couple of years end to end, is that the time to be doing these? I don't mind builds, but you still need to be considering, okay, we need to be doing builds that potentially are all done and dusted and sold, towards the end of 2026 and put ourselves in a good situation to be able to get an understanding of the market, what that looks like, what the economy looks like, what the global expectation is going forward, and then make decisions around what your next deals look like from there. Another consideration for you is the cash flow strategies, of course. They continue to perform generally really well through downturns and through recessions and that kind of stuff as well. And so, of course, if you're in a position to be able to, execute on good cash flow style deals, I've got zero issue with those because, again, price doesn't matter so much or value doesn't matter so much with that. The underlying property market doesn't matter so much with those. They're just going to sit there, continue to create cash and continue to do really well for you. So look, from a graph perspective, this is what Phil Anderson's graph looks like with regard to, I guess, since the 70s. You can see that if you look at property price, now this is American property price as opposed to Australia's, but Australia doesn't look all that different to this. You can see that, after the 2006-2007 global financial crisis, they did tip quite hard. They sort of bottomed out at around that 2013. They grew. Phil talks about a mid-cycle slowdown. So they grew until, effectively COVID. COVID was considered to be that mid-cycle slowdown, which was about 7 years in. And then, they backed off a little bit. And of course, we've seen spectacular growth since then. And so, again, if you're really interested in this, you can look it up. It's really interesting stuff. Do you make all of your decisions back off of all of this? No, right? But it's just a consideration and another consideration for you with regard to, all of the other things that you can think about when you're making your property investment. The interesting thing about this, though, is that a lot of the time, this property cycle, the 18-year property cycle, is obviously attributed back to Phil Anderson. What I included is just a little bit of fun and something that I find really interesting as well. If you go a lot further back into history, you will come across this guy. This is Samuel Benner. And Samuel Benner in 1876 actually published a book which was about economic cycles and property cycles as well by virtue of that. And what I'm showing you here is his graph that he originally published in 1875 around, periods when to make money. This is all about asset growth, asset decline, boom and bust. And if you actually look at those dates and you play them out against dates in the global economy, really, really interesting how much this lines up with various events that have occurred if you go back historically as well, which is fascinating given the fact that this has existed, back in 1875 and 1876. And it's things like this, which is why I don't, completely ignore this. Do I make all of my decisions off of this? No, of course not. It's just one of the other things that I think about. But it really is interesting when you look at history, you line all of those dates up and you go, wow, that is amazing that in 1875, 1876, with some fairly accurate level of prediction within a year or two, either way, there has been these substantial periods of growth and, of course, substantial periods of decline as well. So again, if you don't have a life like me and you like getting into nerdy topics like this, I would encourage you, have a look at these dates, go back in history, have a bit of a look at that, and you'll be really amazed, like I am, as to how accurately this was predicted a very long time ago. So super, super impressive. So hopefully that was helpful. Until next time, as always, I hope it was fun. Happy investing and bye.